But the problem was we had dug such a deep hole that even with growth, you weren't back to where you were. So in 1934 or 35, unemployment fell from 25% to 14%. Then 1937, 38, we had a second recession. And that's what prolonged it and turned it into the Great Depression. We're going through something similar right now. We're going to have a recession in the first quarter of 2021, the quarter we're in right now. Well, this will be what they call back-to-back recession. We had, recession in pretty much the first half of 2020 and a new recession beginning in the first quarter, at least, of 2021, all in the context of a Great Depression. So I focus on the depression aspect of it. You can't have growth. You can't have declining unemployment. There are certainly investment opportunities, but you're looking at depressed growth. You're looking at a prolonged period of change behavior. We're not going to get back to normal or forget about normal. We'll live through it. We'll come out the other side, but things will be permanently different. And that affects all kinds of expectations about growth, asset allocation, and that's really what I focus on in the book.
In today's video, we're diving deep into Jim Rickards' alarming analysis, where he draws parallels between our current economic climate and the Great Depression. Rickards points out that despite some recent growth, the numbers tell a different story, one of prolonged struggle. The first quarter of 2020 saw GDP drop by 5%, followed by a staggering 31% decline in the second quarter. Even with a 33% rebound in the third quarter, we're still far below 2019 levels. Rickards predicts it could take until 2025, at the earliest, to recover fully, if nothing goes wrong in the meantime. This isn't just a recession, it's a slow climb out of a deep, lasting depression.
It's important to understand the distinction laying between a recession and a depression. A recession has a kind of a technical, quantitative definition. It's 2 consecutive quarters of declining GDP. There are a few other bells and whistles involving employment and so forth, but it's a good rule of thumb. There's actually a body that determines that. It's the National Bureau of Economic Research in Cambridge. They call the Boston strikes on recessions. They tell you when it started, when it ended. They said that this recession began in February 2020. I think that's correct. But we can look at the data and see that it was over by probably July. Third quarter growth was very strong, not strong enough to get us out of the hole we had fallen into, but strong enough to end a recession. A depression is different. Depressions are much more long lasting, and people incorrectly assume that, gee, if a recession is 2 quarters of declining GDP, depression is worse. A depression must be 10 quarters of declining GDP, like a really long recession. And that's not the definition. You can have growth in a depression, but the point is it's depressed growth. In other words, it's growth below trend. For example, take the expansion from 10-year expansion from 2009 to 2019. The economy grew for 10 years. It was the longest expansion in U.S. history, but it was also the weakest expansion in U.S. history. Average annual growth was about 2.2%, and all recovery since 1980, average growth was 3.2%. So in other words, you were growing at a full percentage point less than the trend. And so it's that below trend growth, depressed growth relative to trend. That's what makes a depression. And that's what we're in now. So we had growth in the third quarter. That's fine. We'll probably have growth in the fourth quarter, although they keep revising the data downwards, so that target gets smaller. For the full year to 2020, it's going to be one of the weakest years, the largest negative growth, largest drop in GDP ever recorded. My view is we're in a second technical recession in the Depression. And by the way, this happened in the original Great Depression from 1929 to 19. There were 2 technical recessions. There was a recession from 1929 to 1933, very severe. And then there was growth. 1933 was one of the best years in the stock market, 34, 35, 36. We had growth. But the problem was we had dug such a deep hole that even with growth, you weren't back to where you were. So in 1934 or 35, unemployment fell from 25% to 14%. Then 1937, 38, we had a second recession. And that's what prolonged it and turned it into the Great Depression. We're going through something similar right now. We're going to have a recession in the first quarter of 2021, the quarter we're in right now. Well, this will be what they call back-to-back recession. We had, recession in pretty much the first half of 2020 and a new recession beginning in the first quarter, at least, of 2021, all in the context of a Great Depression. So I focus on the depression aspect of it. You can't have growth. You can't have declining unemployment. There are certainly investment opportunities, but you're looking at depressed growth. You're looking at a prolonged period of change behavior. We're not going to get back to normal or forget about normal. We'll live through it. We'll come out the other side, but things will be permanently different. And that affects all kinds of expectations about growth, asset allocation. And that's really what I focus on in the book. That's right. But again, you got to go back to the 2009, 2019 recovery, 10-year recovery. And I said growth was 2.2%. Trend growth prior to that, going back to 1980, was 3.2%. If you want to go back to the end of World War II, it was more like 4.2%. So that's the kind of growth. So you say, gee, 2.2, 3.2, it's only 1 percentage point. What's the big deal? No, 1 percentage point applied to a $20 trillion economy, compounded over 10 years, that adds up to $4 to $5 trillion in lost wealth. In other words, yeah, we had an expansion, but it would have been $4 trillion greater. There would have been $4 trillion more wealth created if we had been able to get back to 3.2%, at which we did not. The same thing is true today. Going back to 2020, first quarter GDP was down about 5%, second quarter down about 31%, and the third quarter it was up about 33%. Aren't we back where we started? The answer is no, because the 33% was applied to a much lower base. In other words, if you start the year at 100, say 2019 is your baseline, and just call it like 100% of 2019, you go down 5%, and then you go down 32%. Now you're around 67% of the old baseline. So even if you go up, let's say 30% or a little higher, 32%, that only gets you back to 87. It gets you 20 points. You get back to 87. You're still 13 percentage points below the old trend. Even if we have, say, 10% growth in the fourth quarter, that gets you another 8 points. You're still back to 95. We're not going to get back to 2019 employment levels in terms of total jobs until 2025 at the earliest. That's if nothing goes wrong in the meantime. But I expect a number of things will go wrong, including a new recession right now. A lot of people don't know, Lane. They know that the stock market peaked in October 1929 and it crashed 89.2% by 1932. So almost nine. That's what a real market crash looks like. And then you ask people, when did it get back to the 1929 level? When did it get back to the old high? People go, it must have been late 30s, early 40s. No, it was 1954. In other words, it took 25 years to get back to the old high. The Nikkei index in Japan hit 40,000 in 1989. It's still not there. That's, people talk about the lost decade. We'll try 3 lost decades. Here we are over 30 years later, and it's still nowhere near the old high. And so and I would say Japan's been in a depression the whole time. So that's what depressions look like. They're multi-year. They're actually intergenerational. You can have growth, but it's not trend growth, and it's not enough to overcome the damage that was done. So we're still way below, even with growth in the third and fourth quarters, we're still well below 2019 base, and we're not going to get to that level for several years at least.
In this next segment, Jim Rickards explores the unsettling parallels between the US and Japan, suggesting that America could be heading toward a prolonged period of weak growth and recurring technical recessions. Rickards points out that Japan's shrinking population has cushioned its economic struggles, but the US doesn't have that luxury. With a growing population, declining labor force participation, and stagnant productivity since the sharp drop in 2020, the US is facing a serious challenge in maintaining economic growth. Rickards raises critical questions about how America can avoid a Japan-like stagnation.
The US is going to resemble Japan. I think it has resembled Japan since 2007, going back before the global financial crisis. But I think that will continue. So just to use Japan as an example, I said they're in a 30-year depression, which they are. They've had a series of technical recessions. Now, the recession might last 6 months, 9 months, a year, sometimes longer, and then they have growth, but they never get back to trend growth. They never get back to the old level. That's my point. Now, Japan's an interesting place. And I had a conversation with him. He was known in the 1980s as Mr. Yen. He was the assistant finance minister of Japan. But I was talking to him about this. So we're in Korea about exactly what we're discussing now, which is that Japan growth has been very weak, with in and out of recession with a prolonged depression, but some growth along the way. And he said, yes, but you have to understand that the population is declining. So if you calculate Japan on a per capita basis, they're actually doing better than on an absolute basis. Absolute growth has been very weak, but if you spread that growth among a smaller population, the per capita numbers are actually significantly higher. That's just fifth grade math. So where you end up is one person owns the whole country and is the richest guy in the world. That's the reductio ad absurdum of what he was describing. He was technically correct, but that doesn't work in America. Our population is increasing. We're a country that likes growth. And we like growth at the individual level and the national level. So the idea that we could be satisfied with weak growth and a declining population is it's just not going to happen. It could be in for a prolonged bout of weak growth. And then the policy question, how do you change that? How do you get out of that? How do you deal with it?
If you guys haven't heard of this term of changing world demographics, aging and birth, I think that was in Mr. Rickards' last book. If you guys want to check that out, but definitely a big impact to. So America's population is growing.
Barely. It's funny. You look around, Japan's population is declining. Russia is declining. Europe is declining. China is flat, but they're approaching a level where they're not going to be at replacement levels. Of course, this is the legacy of the one child policy, which was, we don't have to do a deep dive on that, but that was one of the great blunders of history and aging rapidly. So Japan's flatlining now. Until recently, the United States population had been growing, not at a high rate, but faster than all those other countries I mentioned, mainly because of immigration. The natural birth rate of people in the country was not much better than Europe, at or slightly below replacement level. But we had enough immigration to increase population, but partly because of the policies during the Trump administration, that immigration has been truncated. So we may now be closer to a flat, shall we say, population growth. And of course, that affects output. There are lots of ways to think about GDP, the four-part definition: consumption, investment, government spending, and net exports. But there's an even simpler way to think about it, get to the same place, which is how many people are working and how productive are they? It's working population times productivity. Productivity has been flattish, not very strong for reasons that are not entirely well understood, but it's just the case. And population growth, here we're talking about the labor force, not the total number of people from coast to coast, but how many people are in the labor force. That labor force participation has been declining and fell very sharply during the technical recession that we had in 2020. If your population's declining and your productivity is declining, your GDP is not growing very much at all. That is the situation we're facing in the United States.